My name is Andrew Stotz, and I want to welcome you to Careers in Finance, sponsored by the Valuation Masterclass Bootcamp. I want to welcome everybody today. The purpose of Careers in Finance is to help you build an awesome career in finance. One of the things that I got in my career in finance is that I was happy and I enjoyed it so much. I was just talking to someone earlier, to our guest, about how I never worked till midnight. I left work at about 6. I worked early in the morning, but I didn't kill myself, and I still had a very successful career. So I really want to highlight for everybody, how do we get joy in work, in our career, in finance, whether you've studied finance, whether you've studied engineering, whether you've studied accounting, you want to work in finance. Today, I've got a treat for you. The guest that we have today was actually a guest on my Worst Investment Ever podcast. He was episode 352. His name is Shashank Randev, and basically he is going to teach us and tell us about what his career is, what he's doing right now, and his journey to get there. And most importantly, ask questions, ask any questions, and we'll be happy to answer them. So without further ado, I bring you Shashank Randev. Here we come. Whoops, there you are. Welcome to the show, Shashank.
Hey, Andrew. Thanks for having me.
Yes, it's good to see you. And I was just going through our podcast, episode 352. That was in March of 2021. It's crazy how time flies.
Yes, it does.
So maybe what we'll do is start off by you introducing yourself to the audience, and specifically, what are you doing now? And then we'll get into some of the history, but tell us about what you're doing now so the audience can understand what career in finance you have.
Sure. No, great. Thanks for having me, Andrew. And, it's always a pleasure, to have a conversation with you. My name is Shashank Randev. For the, audience members who joined into the session, thank you for joining in. I am the founder, VC, and co-founder of 100x.vc. It's an early stage seed fund based out of India, investing in very early stage companies, India holding companies, sector agnostic. We've done 127 investments since 2019. And we've invested in D2C brands to deep technology company, commercializing technology companies, SaaS businesses, fintech, a lot of AI-based companies. And currently, I am working on investing in the next set of companies. So we invest in batches. We identify a set of companies at one go, 15, 20. We give them the investment, and then we start working with them. And therefore, we devise them or call them cohorts or classes. And currently, we are on class 10, and we've just invested in 15 companies, hopefully additional 5 by the end of this month, and close the batch at 20, which would have received money from us, which is 160K, and then we work with them for 90 days, 120 days, and then introduce them to the world of other investors to enable the next round of funding, and then repeat, right? And that's the business we are in. We want to empower very early stage founders, give them seed capital, and this also comprises of founders who are fresh out of college. 22% of our entire portfolio comprises of students who freshly passed out and working on business ideas. And yeah, that's the space I operate in.
Is it common to do things as cohorts in this space, or is that something different that you do?
It's different, and thanks for asking that question, Andrew. Typically, venture capital funds decide or typically invest in a volume of 10, 12 companies in a year max, and they fit in somewhere in between the middle of a pyramid structure. And our objective was that there's a lot of opportunity at the bottom of the pyramid, and if we can be the first check writer and act as a discovery fund, now that would be great, right? And hence, as a operative process to manage this more effectively, the best way would be, and we believe that it would be good to identify the set of companies. And we are in the business of speed investing. So not wait for 60 days before we give the money. But if we like an opportunity, within 10, 15 days, deploy the money, because these are very early stage companies. The due diligence should not take longer. And hence we decided that to do it effectively, it's a function of volume in our model. And if it's a function of volume, then it has to be process driven. And one best way to do it is in cohorts. Identify a set of companies, give them capital at one go, work with them, announce them at the VC pitch day, help them raise the next round of funding. And while you're doing that, go back and start looking for newer opportunities, repeat. And the vision is to invest in 100 companies a year. We've not been able to do that so far. We've done 127 cumulatively in 4 years, but just this year we crossed the threshold of 47 investments in the last 6 months. So hopefully this year we might be able to cross the threshold of 100. But yes, it's a unique format, and it's a format which I think only one other fund has done, which is based out of the USA, which is named Y Combinator, and that's been a source of inspiration in terms of doing it for India.
That's great. Before we continue, let me just welcome some of our guests to the show. Here's Haritik Shah. Welcome to the show. Of course, there's Momin, who you just met earlier. Welcome. And we've got, a good friend of mine, neighbor here, who has been to my house. Good to see you. And also, there's Alex and Mercy in Nigeria, and good to see you. And then Ashwin, who is in Thailand. Let's see who else we've got. We've got
one of my friends from Thailand, Amrin, such thing.
Okay, great. Yep, there we are. On fire. And we've got Sodiq from, let's say, hello, everyone. And there's Rainer Michael, he'll have some very good questions for you. Let's see his first one. How did you develop the due diligence skills? And the next one is gauging the legal risk and due diligence. How did you learn this? And as he says, greetings from Singapore. So let's start with that question. Like the due diligence, first you got to find these people, but you can't spend too much time with them because it's, early stage. So tell us a little bit about how you do the due diligence.
So, it's a team effort, right? And when you're setting up a fund, you're essentially, working with folks who can empower you and kind of take you to the next level. And I think one of the biggest things when you're doing such an intensive business is to have the right team members. So we have a great founding team. I have Sanjay, who's the founder and partner. I've got Ninad Karpe, who's the founder and partner. It comes from a corporate background. I've got Yagnesh, who's the CFO and was earlier the operating partner for Bessemer Venture Partners. And he comes with an inherent knowledge of how VCs or growth stage VC funds look at early stage companies, and brings in that financial prowess. And then we've got Vatsal, who's the CTO. So it's a team of complementary skill sets who understand different aspects of business. And I think that collective strength helps us kind of identify, go over the threshold of looking at certain parameters, which are founding team pedigree, how big is the opportunity, business model strength, and then looking at the moat or IP, and then begins the due diligence process. Now, due diligence at this stage is largely lacking data, and but the most important thing is that these are private limited companies. As a VC, you invest in private limited, so these are entities which are registered with the government of India under the registrar of company, or ROC. So you've got some level of data if they file their annual returns. If it's less than a year, even then it's a little more gut driven, because you get to speak with the founders. And the tangible aspect over here is not the financial data, because there's only so much you have, but it's the tangible product which they're building, right? So you're trying to figure out input output of that product, You're trying to figure out, can you as an investor add value and get them set of customers? Are they under the compliance if they're in a fintech sector? Are they complying to the regulatory challenges, or could they face any regulatory hurdles? And this kind of funding is a lot more different than a private equity, right? Where you're doing a due diligence for a 10-year-old company. And those are the nuanced DD processes which are not applicable in these companies, right? This is venture capital, and this is largely product driven and founder driven, and testing whether, if they reach a hurdle, will they bail out, or do they have the grit to kind of, no, I will continue doing? Because that kind of attitude in the early stages matters a lot more, than just the financials, right? And that's the space we operate in. So it's a little gut driven, a little product driven, which is not proven. And your ability to visualize a roadmap for that product in a given market, and how you fundamentally believe internally that if we are able to push this product out with the founders, will we be able to make an X amount of return at some point in time? So I hope that answers the question to some extent. So let me clarify again. Financial due diligence for a seed fund is very different from a private equity fund, because there are so many other parameters, and therefore the qualifications required, let's say CFA is the most sought after individual for a private equity fund, when they're doing a due diligence or scouting for opportunity, because the process is much evolved, and much more granular. For a VC, you're looking for the ability to understand technology and products, and ability to kind of identify the first set of customers. Two very different approaches in terms of doing due diligence.
And before we go on, we've got a couple of others to say hi to. Amit, awesome brother. There's
another friend of mine. Thanks,
there
Amit,
you
for
go.
being here.
Yeah. And we've got Fikeo. You're welcome. Good to see you. And Hillary, who's also in Nigeria. So one next question is, okay, so there's the due diligence aspect. The other question is the monitoring aspect. So, okay, you like this guy, this man, woman, they've got this idea, they've gone through your basic due diligence process, they're in a cohort, you give them some money. How do you monitor them?
It's a good question. So the monitoring aspect, I think, is the most critical one, and that's where the process comes in. Once you've identified, you've deployed the capital, you spend significant time with them, up till the VC pitch day. That is when you announce it to the world, and you want the other follow-on investors to come in and invest into them. And obviously, there you go very granular in terms of, is the product is working? Have you gotten an X amount of customers? Have you raised a purchase order? So on and so forth. If it's a D2C brand, have you managed to onboard a certain set of distributors? Get the business to a certain metric, so that it is more metric driven for the incoming investor, who's very different from us. We might be coming in on hope, and they will come in on hope plus metric, and then a private equity fund will only come in on metric and no hope. Metric is the hope they have, right? And that's how it evolves. Now, post the VC pitch day, we still continue to be investors, right? So how do you manage the large set of portfolio companies? And it's a very proprietary method of management. What you're trying to do is focus on winners, focus on guys who are template, who are delivering on certain metrics, and give them more time. And therefore, all partners have, they take out time every month and schedule particular sector-based companies. Each founder divides certain sectors, take portfolio companies in those sectors, and manage them, so that they're able to kind of move on to the next levels, which is possibly a Series A and Series B. But yes, portfolio management takes a lot of time, and also you need more folks on board. So we've got specialists in those sectors who also work very closely with us in monitoring those companies. So for instance, if you've invested in a deep technology company, which is, they've reached a commercialization stage, but we are horizontal investors, and there are certain nuanced approaches for that particular deep tech company on a product side or on a business development side. We have specialists who are working with these portfolio companies as well. So there are various strategies in terms of portfolio management. There's a founder partners level strategy. There's a venture partner strategy. There's an advisor strategy. and those come into effect depending on which company is falling under which sector.
And how would you describe like lessons that you've learned? Some of the lessons, like, you've had some ups and downs. We talked on the podcast about, one of the investments that you just felt like wasn't going to make it. And then, oh, they made it.
Yeah.
And there was a 7 times gain. I think we talked about on that one.
Yeah.
But what are some of the lessons that you've learned from the winners and the losers?
So, I think the one lesson which you consistently learn with these unstable, unproven models and products is the ability of the founder to push through continuously, right? And as investors, sometimes we undermine that because that's a very human nature, right? I don't know if the founder comes with an excellent pedigree but is depressed generally in life, or if a founder is coming with not so great pedigree but has the zeal to push through anything and never give up attitude, right? And we've seen that persona push through many successful in very successful companies, and I think that trait stands out. And that's exactly what happened with the company which I missed out on investing in, because I couldn't see through that process because they weren't selling the product. And I felt if this is not happening, it's not going to sail through. But they were very clear that they wanted to sell the company and build the technology, right? So the learning usually lies on the investor side, because founders can give you surprises, and which is very inherent in their natures. The out of doing 127 companies, I think we've seen a lot of ups and downs. A lot of companies go beyond expectation. Companies which we'd written off in so many words came back and pivoted, right? I pivoted into something completely different. Now, if I look back and in the kind of business I invested in, um, what the founder is doing at Series A is just completely different. So, in essence, what did I invest in? I ended up investing in the founder first, and that's one of the key criterias of us when we're evaluating founders and the team is the founders' complementary skill sets and their ability to kind of go hand in hand, right? As I like to say, when we're trying to gauge when the shit hits the roof, are they still going to be there, right? And that's a bulk of the thing. So we've seen a bunch of things, and we're still growing. So we are still yet to see our first exit. 10% of our portfolio companies have gone to Series A. We intend to exit at Series B, and those stories are still panning out. But I think one theme which is emerging is that it's always the founder, it's always their inherent uh, nature of not giving up, not going to a corporate job, sticking to that product and selling it to an enterprise in a case of B2B. And I think that sails through many of the difficult situations for particular founders.
I've got a lot of questions for you, but I just want to recognize a good friend of mine, Robert Stockfish. Welcome to the show.
Hey,
Good
Robert.
to see you. And Rainer Michael says, how much is single company or management team call versus industry or sector? I'm not sure. I don't know what team call means, but do you know that?
No, I didn't understand the question. How much is single company or management team call versus industry or sector?
So I guess maybe
Okay, so you're trying. Is this a question related to an investment decision by a single venture capital
yeah, could
fund
be, could be.
or a
Yep.
team, as opposed to a large corporate taking that? If I understand that question from that perspective, then I think VCs, and I was just telling you, Andrew, I finished reading a book recently, and I read a stat over there that 35% of the IPOs over the last 40 years, which went IPO in the US, that 35% lot came from companies which were backed by venture capitalists, right? So inherently, the model has evolved where the tendency by a particular group of individuals in a VC firm have been able to identify and invest into opportunities which have the potential of scaling, right? And within that nuanced approach, I think a lot of large corporates also have their corporate venture capital arms, and they are reaching out to VCs to kind of figure out a process of identifying strategic fitments to their companies because of the vantage point VCs have. So if I've understood the question correctly, and I hope I'm addressing it rightly, it has made a lot of impact in the Valley, in the US, and also now for the last at least 20 years in Southeast Asia and Middle East region, and Israel included.
The other question I had was, once someone takes funding from you, are they prohibited from taking funding from someone else during that period of time, or they can bring in money from anybody at that time?
Good question. So when we are coming in as an investor, um, we would want the founders only to utilize that capital and not focus on fundraising,
Mm,
because we're coming on board as partners. And when we are deploying capital, we don't want them to focus on fundraising and do not co-invest with anybody. That being said, the funding process opens up 90 to 120 days down the line after our investment, right? So the idea is that they can bring in anybody they want post 120 days team, working with the likes of Sequoia, Axel. But for those 90, 120 days post our investment, the focus is utilize our capital and ensure that their product has reached a product market fit or a minimal viable product stage, as I said, quote unquote, that particular X metric, so that it is relevant for a Sequoia or an Axel, right? So from that context, we prohibit them to fundraise, and we ask them to focus on the product, but we open it up at the VC pitch day, which is 90 to 120 days post our investment.
and let's say that a good company, they do well, and you open up to VC, and a VC comes in and says, I want to get in this because I got a lot of expertise here.
Sure.
Are you exiting at that time, or you're going to ride that wave?
No, so as I said, we do not exit. We've
Yep.
still not 127 investments. We've had two acqui hires. We've had 10% of our companies go to Series A. We still haven't exited. So we are long-term investors. We stay invested. We work very closely with the follow-on investors in enabling channel partnerships. But we stay committed. We stay invested. And the idea is to take an exit post Series A or Series B. So our round is typically pre-seed slash seed. Post our VC pitch day would be a pre-series A, and the third round hopefully is a series A, and we intend to take an exit around series B.
Mm. And are you working with the investors that come in, or they got their own deal and they're working with the company, like the VC guys that come in, or do you become silent at that point, or how does that work?
No, I think it's a lot trust driven model, because ours is a discovery fund model. So we
Mm,
are building this ecosystem where the Sequoias or all the other large institutional investors need to fundamentally believe that they are getting curated deals and curated companies which are backed with a sophisticated process of management. And when they come in, they are taking us with them in terms of how the product is evolving. So case in point, I'll give you an example. There's a company called Vitra.ai, which is a deep tech company, and there's a deep tech fund called Inflexor.vc, which came in and invested in them. And our product update calls and business update calls are along with the VC fund, which is Inflexor. Inflexor 100x.vc and the startup come together, right? So that is a given process. Obviously, there are standalone processes which the follow-on investor might follow, but at any given point in time, a 100x portfolio is also working very, very closely with the follow-on investors.
and when new funding comes in over time, the VC and Series A, Series B, whatever happens over time, are you participating in that, like adding in new capital, or are you happy to be just diluted down and you've got your share and you've got in at the beginning, so no matter what it is, it's going to be a big payout for you?
Sure. No, and that's a great question you've asked. And a typical model for a VC is to do a set of number of investments, 10, 13, 14 per year, and preserve capital for follow-on funding round for the winners, right? That is not the model we follow. That's why it's a seed fund discovery model. The idea is to invest in volumes. We want to enable the process of entrepreneurship. I said 27, 22% of our portfolio companies are student driven, right? Idea is nobody will fund them at this stage, and there's only so much they can do to reach up to a growth stage VC, right? That's where we come in. So ours is a very strict model of investing the first check, no follow-on investments, right, till we cross a threshold, right? So right now we are at 127 plus another 15 which are yet to announce. So once we cross the threshold of 350 400 companies, maybe then we'll think of doing follow-on investments, but for now we do not.
Um, the other question I have is, as an analyst, all my career, I always did like many analysts, which is like, what's your growth profile of your company? But now, my business partner Alex and I, he came up with something that I think was very valuable, and that is to start asking the question. And I want everybody who's watching this and listening to this to think about the answer to this question in your head. What is your constraint to growth? What is holding your firm back from being much bigger? Is it funding that you guys get? Is it sourcing the deals? Is it the quality of the deals? Is it just paperwork? I mean, what is your number one constraint to growth for your business?
It's a good question. So when we started the fund, the idea was to address the first point, paperwork, right? And that had to be reduced if you're doing volume. And that's why we introduced iSAFE notes. So that removes the friction out of the process of investment and essentially enable founders to raise money very swiftly. So we addressed that point. This is not Silicon Valley, this is India, which is still evolving. So the problem statement over here is, if you have a model of doing 100 companies a year, do you have quality deals which are going to fit into that criteria? And I think that remains and will continue to remain, where you're able to identify companies and immediately say, I want to invest in them. So one thing which we've learned, and India is growing and we've seen great opportunities emerge, but we've also seen out of 127 companies which we've invested in, we evaluated 26,000 businesses over the last 4 years.
What?
The conversion rate is 127. We evaluated uh, 26,000 businesses, which made we had roughly 8,000 come into our office or reached an investment committee meeting. And then from there on, we invested in 127. Now, to say that all the other ideas were bad is not correct. So one of the things is you manage the progress of these companies, which are neither here nor there, right? And how do you kind of ensure that there's a process of not missing out on opportunities which were not great 3 years back, but are now fundamentally great, right? And I think that is requires a lot of legwork, requires a lot of operational prowess to kind of continuously manage that. And I think in a growing economy like India, I think that is a problem statement which we kind of dabble with. How to not miss out on opportunities, and we can't back down from the fact that okay, this year we'll do only 5. We want to fundamentally do 100 investments. So hence a tracking methodology of managing the companies you've rejected who could possibly be doing good stuff, right? And I think that is a place where 100x kind of continuously works, and we've got our own set of processes to kind of figure out a particular quarterly update and a follow-up email on that particular founder. Hey, what's the update? And receive, and then do a follow-up call. All of that, I think that takes a bulk of our time. But that being said, the only challenge in this kind of a model remains identifying great opportunities in volume, right? And that, I think, with time, from 4 years ago when we started to what we are in today, India's changed a lot. There are a lot better ideas. Founders have evolved. Second-time entrepreneurs are coming out, and we're seeing a better quality of output from incubation centers and accelerators and e-cells.
I just thought, from one of the questions that we got in, I'm going to try to share my screen here for a second and see if I can make this work. So hold on one second. Let's see. All right. So one of the questions from Hillary was, what are iSAFE notes? And to answer that, I've gone to your website where you can see, and I can include the website in the chat so you can check this out. So I've just put the link in the chat. But here we can see iSAFE notes, valuation cap, discount, valuation cap with discount, MFN. Maybe you can just briefly explain, what are iSAFE notes?
Sure. So, typically what happens is when a venture capital firm is investing into a company, they're valuing the company. And the value process comes through a shareholders agreement, which, Andrew, as you might appreciate, consists of methodologies. It includes discounted cash flow, DCF methodology. And all of that is not applicable in a business which is right outside of college, building a medtech product and figuring out if the product is going to be acceptable in a hospital. There's no business around that yet, right? And hence there is no inherent valuation. So does that mean that you don't fund those businesses and you wait till the time they grow, and there's less chance of them growing? there's a higher probability they'll fail, right? So when we were setting up this fund, the iSAFE methodology, which is inspired from Y Combinator, which does safe notes, is the term is India's simple agreement for future equity, which means that you are able to take money from us as a fund today. We do not value your company or take the shares up front, right? And the process of that conversion takes place whenever you're able to raise the next round from an incoming VC. Now, the idea is that if I'm giving you money, I'm believing the product journey, the product roadmap, and the market opportunity. I'm building it with you all the way up to that level. And the valuation is determined then by the incoming Sequoias or the Axels or the other growth stage VCs, right? And the benefit of iSafe is that it enables fundraising for these entrepreneurs who are at that stage, who are not growth stage VC ready, to close investment of 160K USD within 10 to 15 days, money into account. Now, at this stage, you are seeking that infusion of money rather than determining what my value. And many founders come to us, my valuation is this. I said, why are you guys thinking about valuation? You've not built your product, right? Your focus should be how to raise money to build that out, to reach a product market fit so that it's valued, so that you've created some value, right? And that's why the whole process of iSafe came in. So it by the under the legal context, it means compulsory convertible preference share, which essentially enables founders to sign this document through a DocuSign and receive money within 24 hours and start going on and building their business. And we are the only fund in India which is doing all our investments through iSafe, because if I was a growth stage fund, I would be doing SHA because that's what is required at that level. But I'm not. We are a seed fund, and seed funds don't require SHAs. Seed funds need to deploy capital soon, and iSafe works in that process.
Yeah, I mean, it's always kind of silly to hear people talking about valuation when they really don't have anything to value. What happens when the VC comes in? Does the iSafe valuation, does the iSafe document no longer valid? Is it valid up to VC, or it's valid for as long as you're holding shares?
No, so we essentially get our shares when the next VC comes in, and the conversion of our equity comes in. Now there's an incentive for that, because I'm working equally hard with the founders, because if I don't, and if they don't succeed in raising that round, I don't get converted into equity, right? And eventually that's the whole objective. So we get converted into the equity whenever the next shareholders round happens, because that's the price round. So iSafe is another way of saying that we give you money and the conversion happens at a price round, which is a shareholders round. But we get converted at that round.
And is there a standard percentage that you're getting?
Sure. So we do. When we started the fund, we started with a small check size of 35K USD for a future of 7% equity. We did 80 investments. We deployed 3.5 mil USD, and these companies went on to raise 65 mil, out of which 10% are now at Series A. We've now increased our check size to 160K USD, which is for a future of 15%. We've done 47 investments, and these companies now have. So we as a fund have now cumulatively invested 9.5 million, and intend to invest another 10 million over the next 8-9 months. And these companies, the latest 47 investments which we've done with the 160K size for a future of 15%, they've gone ahead and cumulatively raised roughly around 10 to 11 million USD. Right.
Okay. I think Amarin was you said your friend. He's going to ask you some tough questions here.
Okay, from the 127 VCs that are funded. Oh, you mean 127 startups which are funded?
Startups.
Are all still showing good progress, and how involved are you with all the businesses? I suppose the question would be, what percentage of your time is given to seeing newer opportunity versus VCs already? Great question. I think, and I answered that earlier, is that the portfolio management is a bulk process, right? And as I said, so out of the 127, first, let me give you the stats. Out of the 127 companies over the last 4 years, we've had 4 acqui-hires. We have 10% of the companies which have gone to Series A, and 5% now going to Series B. The other are falling in between, which are essentially operating at a margin of 3x to a 7x, which is not bad. And we've had three companies which have shut shop, and they've shut shop because of how the COVID wave came in, and COVID directly impacted the business, and the founders weren't able to pivot. So out of the 127, I would say roughly 124 are operational, and 4 have been acqui-hired. So we are working with a pool of 120 companies, out of which at least 20 have gone to a Series A, and a good set of companies are now working towards Series B. Now, coming to the portfolio management, as I mentioned earlier to Andrew, that we have 5 of us. We each bring in special perspectives. So we have each sectors which are divided between us, and we manage portfolio companies within that. So that's effectively managed. And then also we've got venture partners and advisors who work specifically with these companies. So for instance, as I highlighted earlier, if it's a deep tech company, and deep tech companies, as you might appreciate, come in when you invest as a seed investor, you're essentially investing in R&D phase. Now, from that stage to commercialization is a long process, unlike a D2C brand. And therefore, if you have a venture partner in a special domain, IoT or deep tech, then we bring those guys in and they kind of work with that. So that's the model, and this is a standard model across many VCs as well, where they have specialists come in and they kind of figure out, while the entire portfolio is managed by the GPs or general partners, which is us. And that kind of is our attempt, and almost every VC's attempt, to effectively manage as much as they can their portfolios, which are ever growing.
One other question I have is, what happens inevitably when a founder basically gets your funding, they spend it as they said that they would, revenue doesn't come in as fast as they think, and all of a sudden they need money. And then you're faced with some situation or dilemma, and I'm just curious, how do you resolve that?
So, it's a great question, and that's why I said that the first 90 days post investment is a very crucial period for us, and we work and monitor these guys very, very closely, because the output for us is going to happen at the VC pitch day, right? And hence we are very focused and tight-fisted in terms of how they're utilizing the money. There's a close eye in terms of the utilization of 160K. So their product roadmaps on weekly basis, their business progress on a weekly basis, and that kind of helps us monitor the utilization of capital. That being said, there are cases where the funds can fall short, but that happens only post the VC pitch. So what happens in a typical scenario is that they've utilized the capital and they're doing a great job, and they were expecting to, let's say, hypothetically raise 500K, and the commitment came through after 120 days of our investment, and from that day it's taken another 90 days because it's an SHA round. And it's just taking time in terms of due diligence. Now, by then, if they're falling short and their burn rate increase, the only way of kind of bridging that gap, if they're raising 500K, we've seen in some of the companies, they've gone ahead and raised a sequel safe note of 100K. They are super angels who are coming from those industry domains which are connected to 100X. Let's say it's a SaaS company and they got a commitment of 500K, but they still need 100K because the SHA round is taking time. SQL Safe Note enables that, and all of us have a network of these super angels working in specific domains like SaaS, and we've seen this in many of our portfolio companies. There was a fintech company which was raising SHA round with a growth stage VC fund, and that took 90 to 120 day to a 180-day process, and the term sheet was there and there was not a hard pass, but the money hadn't come in, right? So what do you do in that situation? So there was a fintech super angel who's invested in many of our portfolio companies, and he wanted to join the round, and he said, I'll invest 50K. But when he heard this, he said, okay, let me build the round 50K plus another 100K with my set of folks and bring in. So I think that's the network effect which comes in with funds like us, right? It's a mixed bag of working with growth stage investors and they following their process, but also addressing that the importance of super angels in such a community of early stage companies plays a very, very important role. And that's why they're called angels, right? They come in, okay, let me just come in because I believe in this philosophy and this theme. And we've seen this time and again in many of our portfolios.
It's amazing. So Amrin's coming back and also asking, are you investing only in India? Sounds like he may need
So,
some money.
no, so he's a great entrepreneur
Yes.
himself. He's been doing great
Okay.
work for many years. So kudos to that. And no, not for now.
Mm.
We are an India focused fund, and we are only investing in Indian holding companies. That being said, many of our companies post our investment, raise money, and then go ahead and register themselves in Singapore or Delaware. But as a fund, for now and for the foreseeable future, we are only focusing on the India story and investing in Indian holding companies.
Mm. One question I have for you related to career is, like, I didn't like this type of job myself because I felt like I don't want to go from one company to another to another to another. I wanted to focus as an analyst deep into one industry, one sector, which I did in the banking industry, in particular in Thailand. What type of personality, maybe let's talk about careers in finance now, and think about,
Sure.
for a young person out there that's thinking about, is this right for me or not? What would you say is like the characteristics, or what is it that would make this suitable for certain people?
So I like to highlight my personal background, which is not coming from a finance background. I'm an engineer, and I worked with large IT companies before pursuing my MBA. And then post MBA, I joined as a founding member for a startup which was building a SaaS product for the venture capital and private equity industry. We got acquired by a news corporation, so that gave me a vantage point. And then I started doing a bunch of investments, joined a US based fund, and then kickstarted 100x, right? And the reason why this is successful, as I said, is because you bring in experts, right? So we've got a partner who's a CFO, right? And he understands the nuanced approaches of regulations and specifics around finance. That being said, right, many of the most successful investors I've seen, super angels, fund managers, don't inherently come from a finance domain per se. They come in from a finance blended uh, uh, tech. This is, I think, a prerequisite for a career in venture capital. When you talk about private equity funds, now therein you're evaluating companies which are more traditional or slightly mature, right? And
Mm.
there in the CFA level, fundamentals are more important because the technology is already proven. You're monitoring the business, hardcore business, right? Once you've achieved a 10,000 base of employee and a revenue of, let's say, $500 million, from there on it gets into very specific numbers and, month on month growth. How much can you achieve that? So two different ways of looking at it. That being said, uh, and as I was telling you earlier, uh, the there are so many opportunities today for founders to kind of experiment, and for individuals who are seeking opportunities, compared to what was the scenario 20 years ago. Right? Today, we are effectively seeing the gig economy come into existence. We're seeing a lot of Gen Z folks not wanting to work 9 to 6, but picking up individual projects and getting paid for it, right? And the requirement by organizations, startups, mature startups, and larger organizations have also started appreciating that, do I actually need an individual on my payroll, or is this a project driven approach on a consultancy basis, right? And I think that approach of doing business and working, I think, is the first time which I've seen. When we started studying in education, the idea was to get into a specific profession. Today,
Mm.
you can pick up many modules, learn from various aspects, and pick up anything for a specific time, because organizations have opened up of bringing in a design thinking individual to kind of figure out a process for 4 months. Um, Somebody who's a specialist in managing technology and rolling out a product cycle, bringing that person for 6 months, right? And if you are an individual who's not certain of working in one line forever, can you have the opportunity to experiment with multiple professions before you kind of figure out, okay, this is the one I want to go out with. Also, by doing that, you are inherently building a network effect. More people know about your work, more people will talk about your work, and that virality factor is what is the most important and credible thing in this ecosystem, right? So I personally feel, Andrew, that the times we are living in right now is way different from 20 years ago when we guys were trying to build out our careers. And today there are more options, if you think, more possibilities of experimentation, more more chances of failing and then trying again and not being outcasted, right? And that kind of approach, I think, is great for this Gen Z, which are trying to seek out opportunities.
I want to wrap up by asking you to give us, three pieces of advice or three words of wisdom or three lessons that you've learned from your career, from your life. It's an open platform. So think about what three things, and then I'm curious to learn from you.
Yeah, as you know, I think and I can give you an India perspective. I think a lot has changed in India. There's been a proliferation of information, data access, and just general connectivity, and that has kind of enabled tapping into talent across geographies and getting vivid experiences from folks from hailing from different cities and different cultural backgrounds, which has kind of enabled the process of building in India, right? And through my personal journey and through what we are doing at 100x, and the kind of founders we are learning from and continuously backing, I think what we are seeing is uh, it's a great time to try and fail if you're a first time entrepreneur. If you're young in the age group of 18 to 30, it's a great time to experiment and figure out, because each experience is kind of giving volume of credibility on your resume. If I have to interview somebody, I look at a failed entrepreneur CV and I know he's worked on 5 projects. What I'm not essentially judging him on is his failure, but his ability to kind of manage those projects. Failed outcome is one thing, but his ability of having gone through that process and then reiterating, I think that
Mm.
trait is important. So that is one thing which we've learned a lot, and that helps us a lot in terms of evaluating very early stage founders. I think second thing is, as much as you experiment, you still need to kind of build a model of profitability, because at the end of the day, all this euphoria and excitement and newer technologies and then talking about that and looking cool and all that is one aspect, but the other aspect is then it gets serious in terms of the viability of business, right? And I think learning that eventually all this effort needs to convert into profitability, needs to convert into a business which is likely to go to an IPO, is a
Mm.
sustainable and stable business, is, I think, one thing which we've learned time and again in early stage. And that's one thing which we've tried to incorporate in our investment thesis, that you need to be able to envision the mindset of that founder. Are they able to build for scale, right? And the third thing I've learned to appreciate is that while sometimes when VCs are castrized for the point of saying that blitz scaling is important, and in the process of disrupting, you're just disrupting a lot, and then who's accountable for the failures. I think what we've also learned as first time investors, it's a new fund for us as well, only 4 years old, is that blitz scaling is the process of attempting to build something which is utilized by the consumer and utilized on a regular basis, which is generating a recurring revenue, which is increasing on a percentage growth, which as a function of all this drives valuation. And if you so as an investor, you need to continuously pump the founders, but in that direction, that is not destroy everything else to succeed, but to figure out that as you continuously grow, collaborative opportunities will emerge, and you will need to kind of enter new markets where you can't be the leader, you'll have to collaborate, right? And how are you building that sustained profitable business? So I mean, these are the things which we've learned, and I think these are the tips which I'll give, that when you're seeking career, either in the finance industry on the VC or private equity side, or in a startup or a growth stage company, I think figure out how you're learning to be part of that team, which is building consistency, and driving value, which is profitability, which is continuing to pay salaries for the company, for the employees, right? And that's the mindset I would encourage all guys to pursue, rather than the cool factor of being working for a startup. That's I think a tip I like to give.
All right. And just hold on for a second. We're going to come back. But I just want to mention to everyone that Careers in Finance is sponsored by Valuation Masterclass Bootcamp. You can scan that QR code or go to valuationmasterclass.com/bootcamp to learn more. The next bootcamp starts on September 4th. Well, Shashank, I want to thank you for joining us. You and I will talk for a couple of minutes after we turn off the video. But I thank you for coming on, sharing your work that you're doing. Is fascinating. I learned a lot, about it. And I think you inspired some people to think about how to have a job in this, early stage investing and what it takes. And I think it's very exciting. So thank you for sharing, your journey, and I appreciate it very much.
Thanks, Andrew, for having me. Always a pleasure, and looking forward to being on the show again.
Yes, we can talk some more for sure. All right, ladies and gentlemen, remember that the Careers in Finance is brought to you by Valuation Masterclass Bootcamp. Valuationmasterclass.com/bootcamp. We'll see you there, and we will say goodbye, and I'll see you in just a minute. But thank you, Shashank. Have a good evening.